If you work for yourself, the tax code rewards aggressive write-offs that push your taxable income as low as legally possible. But when you apply for a mortgage, that exact same strategy works against you. For a standard W-2 employee, getting a loan is a straight line. The bank looks at their gross salary, checks their debts, and hands them an approval. This math breaks down for the self-employed. Traditional qualification follows a linear path, but your income is measured after deducting mileage, home office, and depreciation. $250,000 gross can become $30,000 net, triggering a conventional denial. Specialized underwriting frameworks, known as alternative documentation or non-QM loans, bypass tax returns to measure the actual cash flow of your operation. The trade-off is precision. By moving away from tax returns, you invite underwriters to audit your daily operations, often in exchange for a higher rate. You don't need to unravel a smart tax strategy to buy property. You just need to align your specific business structure with the exact loan program built to measure it. Let's start with gig workers, consultants, and independent contractors. If your income is strictly reported on a 1099 NEC, you belong on the 1099 loan path. Instead of handing over tax returns, you submit 1 or 2 years of your official 1099 statements to verify your earnings. Lenders use these documents to qualify you based directly on your top-line contractor revenue, ignoring your net profit entirely. But there is a strict limit. To use this program, you have to prove your business operates with an expense ratio under 20%. If you manage delivery fleets, pay regular payroll, or lease commercial space, your overhead is too high. The underwriter will disqualify you from this specific path and require a different calculation. And if you hustle in multiple lanes, say IT consulting during the week and driving rideshare on the weekends, you have to show a full 2-year history in each distinct industry for that combined income to count. This path works for low overhead sole operators. If your business is capital intensive, you have to look elsewhere. If you hold 25% or more equity in an established business, an LLC, or operate as a sole proprietor, you shift to the bank statement loan path. The core requirement here is providing 12 to 24 months of your business or personal bank statements. Underwriters calculate your income by creating a historical average of the actual real-world cash deposits flowing into those accounts. Underwriters actively hunt for large, irregular spikes, like a sudden equipment sale, and subtract them from your qualifying average. To stabilize this, lenders require a CPA-prepared year-to-date profit and loss statement, verifying net earnings haven't dropped by more than 10%. Bank statement loans reward businesses with a consistent, paper-trailed cash flow, but they penalize erratic operations that rely on sporadic cash. If you are purchasing properties strictly for rental income, you bypass personal business income entirely and move to the DSCR loan path. DSCR stands for Debt Service Coverage Ratio. It's a formula that divides the subject property's gross monthly rent by its total monthly debt obligations. If the rent covers the mortgage, the property qualifies itself. The lender requires 0 personal income or employment verification from you as the investor. Cautionary: as seen in these guidelines, this leniency comes with rigid occupancy rules. The property must be for business use only, and your immediate family cannot live there. Because the property itself carries the risk, these loans also feature tight prepayment penalties, effectively preventing you from flipping the house for a quick profit. By trading personal income limits for strict commercial use rules, DSCR loans offer landlords a clear method for scaling a real estate portfolio. Securing a mortgage as a business owner requires matching your operational reality to the specific loan program built for it. This checklist breaks down the 1099 path, built for digital freelancers, but fails if your operation requires heavy overhead. The bank statement column is perfect for consistent equity owners, but rejects erratic cash flow. Finally, DSCR highlights its necessity for scaling landlords. When you speak to a mortgage broker, lead with your business structure and specifically request the alternative documentation path that fits your actual cash flow. Taking control of your mortgage means treating your business documentation as a tool, rather than fighting a traditional tax standard never built for you.